Welcome. My name is Martin Straight. I'm the founder of Trend News. We publish three investment services: the Trend Letter, Trend Technical Trader, and Trend Disruptors. And today I wanted to introduce a new service we're offering, and this is a free service. We're calling it the 10-minute Trend Timer. And what it is going to be a series of short market updates via video. We're going to try and keep them under 10 minutes. And the whole goal here is to help investors better understand what is driving these markets today. Now, topics will be based on the questions that we get from you, the viewers. And so send any of the topics that you would like covered to info@thetrendletter.com, and we'll put that email address at the end of this. And also be sure to subscribe to our YouTube channel, and that will give you notifications when we do post our next video. Now, today's video is from a number of questions we've received over the last few weeks. And the question is, if the Fed starts to cut rates, is that the green light to buy stocks? So, we've certainly seen in the last, last month or so, couple of months, where the market's been really cheering on that the Fed appears to be done raising rates. Now, that may or may not be true. We hope it is, but we certainly think that they're very close to if they're not done. But also many of these mainstream commentators, they've been saying that once the Fed starts cutting rates, that will be the time to buy stocks. That's the time, they say, to back up the truck. Well, we want to show you how history has played out, and it's a bit of a different story. Here's a chart showing the Fed fund rates and the S&P 500. So Fed rates in the brownish orange, and the S&P in blue, and these gray bars here are recessions. So when we look back over the last four cycles of these, we can see that back in 1998, the Fed, after pausing and raising rates, they started to cut rates. And what prompted them to do that? Well, they did it because the Asian financial crisis had kicked in. And what they did is that they wanted to stop the concern of a global economic problem. And so what they did is they started to cut rates to ease the pain on the economy. Now, how did the markets react to that? The markets didn't like that. The markets do not like crises. So the Fed started cutting rates. There was panic in the air. The markets declined. Now, eventually, the Fed stopped cutting rates. And the reason being, of course, is that the crisis was over. And what happened then? Well, the stock market loved that. The economy's okay, and off we go again. And that takes us up until about 2001, when the Fed started to cut rates again. And why did they do that? Well, I'm sure we can all remember the dot-com crash. The economy was declining. We were heading into a recession. It was not good. And it was a steep decline here. They cut rates for quite a period of time. But what happened? Well, what did the stock market do? Well, the stock market hated it. I'm pretty sure most people remember, if you had, internet stocks and you didn't sell somewhere near here, you got murdered. The NASDAQ lost 75% of its value over that period. So, again, economy crashing, recessions, the markets hate that. But again, eventually the Fed quit raising or cutting rates. And reason was the economy started to improve. And so how did the market like that? They loved it. Again, the market's starting to go up. The economy's doing well, all good, until the next crisis. So what happened here? The Fed started to cut rates again in 2007, 2008 era. This was Ben Bernanke era. I mean, he took the rates from about 5.4% all the way down to almost zero. And why did he do that? Well, I'm pretty sure everybody remembers the credit and financial crisis. Again, economy heading into a deep recession here. And, this was all the, the mortgage, crisis, huge slash of the Fed rate. And how did the markets deal with that? They did not like it. The market crashed again. And again, eventually, the Fed quit cutting rates. And why did they quit cutting rates? Because the crisis was over. So now one of the things that happened here, as we notice, is that this Bernanke He took the rates down to 0 and he left them there. They left them there for like 6, 7 years. And so how did the markets like that? Well, they loved it. You know, we had companies were able to borrow almost free money. Households were able to buy houses. You know, mortgage rates were very low. People could go borrow and buy all kinds of new toys and utilities because, you know, there's no interest. I mean, there's very low interest rate. Credit was cheap. And so the markets just love that. Until what happened next? Well, of course, we had COVID. You know, we had a global economy shut down. We had the global supply chain shut down. And then, of course, we had markets crash. We had governments handing out stimulus checks, you know, $2,000 a month, you know, left, right, and center. And so what happened there? You know, eventually we had the markets, the Fed, you know, they stopped cutting rates. The problem for the Fed was they did not raise rates soon enough. You'll remember back when all this was happening, the Fed said that inflation was transitory. But what they seemed to fail to realize is that when the supply chain was shut down and you're handing out thousands of dollars to everybody in their home, that you created this new demand for really limited goods. I mean, all these people had this new cash in the pocket and they wanted to buy stuff, yet the supply chain shut down. So goods were really hard to get. So that drove inflation up. And it went up so fast that the Fed started chasing it. And that's why we saw this dramatic rise in rates from almost 0% up to almost, you know, 5.3% today. And that's where we are today. So the question is, what now? So, you know, if people are wanting the Fed to cut rates, they need to understand, you know, be careful what you wish for. Because why would the Fed need to cut rates? Well, they would cut them because the economy is in trouble. They'd be worrying about deflation. They'd be worrying about a recession. And as we just saw, stocks do not do well in recessions. You know, people become very risk adverse. Pessimism is driving the economy. You know, sell-offs are significant. I mean, we saw, you know, the dot-com one, you know, NASDAQ down 75%. You know, that creates panic. So if we see the Bank of Canada or the Fed start to cut rates here, that tells us that they're very worried about the economy. So that tells us also that we're likely to see the stock markets decline, and not just decline, but probably have a serious correction. So we just saw what happened. So when the Fed cuts rates, it's because of a crisis. The market doesn't like it. .com cut rates, major decline. Financial crisis, cut rates, major correction. COVID, cut rates. It was short-lived, but it was a steep, steep decline. So, you know, for people that say that, you know, they want to see the Fed cut rates, they don't seem to understand that that means that the economy is in trouble, and that's not good for stocks. So the time to buy stocks is when the Fed is cutting rates. The time to buy is when they stop cutting rates. And we just saw that. They stopped cutting here, the market rallied. They stopped cutting here, the market had a great rally. They stopped cutting here, the market had a 10-year, and then another pause at COVID, and we've been rallying ever since. So the key is you want to know that when they stop cutting rates, that's the time you're going to be wanting to back up the truck. Now, hopefully this has been of use to you. Hopefully it's opened your eyes a little bit. So when you hear these commentators telling you, you know, wait for the cuts and that's the time to buy, that's not what history says. Give us your feedback. Tell us any scenarios you would like to see explained. Send any of those questions or ideas to info@thetrendletter.com. Also, be sure to hit the subscribe button down below to make sure you get notification of any new videos we put up. All right, until then, take care.